Hi, everyone. Welcome to episode 2 of this series of lives that will happen every Friday at 12 p.m. We're a little late. My apologies about that. So, my name is Adam Levine. I'm a private lender, and I've been lending for over 10 years, private lending before institutional capital flood the market. And we are off to the races now with private lending. It's super excited. And today's episode is pretty interesting. It just happened recently. The title of the episode is Maximizing Fix and Flip Strategies Using Gap Funding. Okay. So basically, this is for someone that, it could be a beginner or even experienced investors that are looking to scale their fix and flip business, or even, fixing, flipping, and refinancing into a long-term rental or DSCR loan, or it could be any type of long-term loan. Okay, so basically, this topic is I'm very passionate about because I do it a lot with our clients because we work with different buckets of capital. We have our own capital, we work with institutional, and we have other investors that we uh, allow to partake in deals with us. They come in as lenders. So what's interesting is that a lot of times I always try to think of topics that cater to our audience. This one actually just happened recently, and we actually closed on this loan yesterday. It's an interesting loan in Somerset, New Jersey. That's where our office is, so it's right in my backyard. And basically, for example, gap funding is something that is definitely more risk. We do take into consideration, this came as someone that we came as a referral from someone that I know and someone that I respect tremendously, and they're working together. This new borrower is new in terms of working with us, and what ended up happening was we for like a standard loan, for example, a 90-100, meaning you're coming in with 10% down for giving you 100% construction up to, let's say, 70% of the after repair value. Give me a second, we can get that off my screen. And what happens is I just had something popped up and I'm trying to find it again. Give me a second. Here it is. All right, I just want to put this over here. So I'm looking at this screen. So I have like two screens. So what happened was this client came to me, and so generally to qualify for a standalone without gap funding, or the max leverage we'll give is 90% or 90-100. You put 10% down, we'll give you 100% construction up to 70% of the after repair value. And generally, to qualify for that, we like to see, let's say, 6 similar completed flips, or it could be 6 similar deals that you either bought, renovated, and sold, or bought, renovated, and held as a long-term hold or whatnot. We generally go back. We go back about a 3-year look back, and we could go further. Rentals, only rentals counts. So that's a whole other topic, how to qualify. Basically, what happened was we this client basically thought that I guess what happened was a, a lot of deals were like she could only show so many, less than 6 deals under her name, or under her name, and then she had a realtor license, but she was under the assumption that she qualified for 91. I thought so too until it came to proving it. So what ended up happening was instead of coming out of pocket 10% down to close on the property, it was now 15%. So, and this is something that we got creative. Like, okay, I guess it's a misunderstanding. It's fine, but I like the borrower. I think it's very, very nice. I like the character. I look at like the 4 C's, credit analysis, credit, collateral, capacity, character. I like the character, credit, good. I like the deal also too. I like this deal. It's local in my backyard, and so I felt good. It's a small little deal too. Um, we're talking of a purchase price of $239,500. The renovation budget is rather small, 50,000. ARV is around 400,000. So, and in Somerset, this property should sell rather fast. Actually, is this Somerset or Boundbrook? I might be mixing them up, but because we do a lot of this. Let's say Somerset. Doesn't really matter. I'm not going to give the actual address right now. But so what we did was we keep in mind that 85% is more, the first loan is institutional. We close those loans, we sell them off. And then we'll come in, we'll give gap funding. On this one, we're providing the gap funding where we're coming in, actually giving this client an extra, we're bringing it up to 97% loan to cost. So basically, we gave another loan to roll in closing costs into the loan. So basically, her out of pocket would have been, let's say, let me look at it. The out of pocket would have been around 47,000. With the gap funding, she's only coming out of pocket about half of that. So that's kind of like a scenario of what we were able to do. So let me go back, right? So this is strategies for that you can leverage gap funding for. And, so let's say going back, this client didn't qualify for the 9100, right? What happened? Doesn't have the experience. Qualifies for 8500, meaning she only has to put 15% down. We still give 100% construction up to 70% of the ARV. We could go to 75 on case by case. So what we did was, as a solution, going back, we're giving her 85% on the first loan. Then on the second one, we're going to give her an extra, let's say, we're bringing her up to 97%. So we're giving her an extra, actually giving her a lot more. We're giving her a lot more. So let me see something real quick. This is their deal in front of me. So this deal this was like a really good solution. And what happens is, let's say if you're, you come to me or you go to another lender, a lot of people do this. This is something very, very, very common that, they'll come to me and say, hey, you know what? I qualify. I got, whatever. They'll go bring their gap funder, and you can use that gap funding money for your down payment money, right? Which is amazing. And, there's other strategies too. Like you could go get unsecured lines of credit or whatnot. But this particular scenario, with a time-sensitive closing, I felt good about it. And, it's not 100% financing, but, we're talking about half the money out of pocket. And the reason why, she wants this is because she wants to do about 10, 12 deals a year. So now she could take that extra 20,000 that would have been in this deal, and she could use that to buy another property. You know what? As long as she brings me similar deals like this, I mean, obviously, I'm not going to commit gap funding on every deal because I want to look at it, but I like it. It's local. We got a resale value, in Somerset. I think it's Somerset or Boundbrook. I'm getting them confused but let's say this one Somerset in 40,000, which is sell rather quickly, single family house, because we're catering with the masses. So we're eating with the class. I like that, meat and potatoes type of, what some people call it, type of property. And I feel comfortable because she should be in and out in less than 6 months. And this is something very interesting. A lot of clients. So another thing I want to mention is about that was very interesting is actually we have another deal, same thing that's happening on that. Clients coming to me, they need 30,000 cover closing costs. We're going to do the same thing, and we do this a lot. And now going back to using gap funding, you could use it for, let's say, covering interest payments for 6 months. You could prepay, so if you're looking for gap funding or you come to me or go to someone else, you could use it. Like a lot of investors will use it to cover their down payment, cover, money, construction, whatever it is. Like, let's say you have a $50,000 rental budget, they'll have, money for down payment. They'll have money to cover the rental budget to get the project started, and they'll have that money to pay interest payments. The one thing with me is when you come to me, we're a one-stop shop. So we'll take care of everything. And I have clients that they keep on coming back because they, the money's more expensive. For example, if you come to me and you're like, oh, you know what, I don't need gap funding, I'll be my own gap funder. This loan would have been cheaper for the client. The fact that I'm bringing all the resources there, it's more expensive. Which she's okay. She's, because she's putting out less money. She knows it's there, and we're going to close on time, and we make it as smooth as possible. There's always, obviously, I don't know anybody that could name a perfect transaction in real estate going smoothly. It never happens, always. But so, and that's really gap funding. I mean, we'll secure it as a second. We could either cross collateral. So there's so many different ways we could chop it up, but to go back again for people that are just watching or just coming back, is there any comments though, anybody? Because I know I'm just rambling on, but I want to make sure that people understand what we're talking about. So gap funding, is basically you're filling in the gap, right? So for example, the gap on this one there's 15% equity gap. 5% equity to get the 90%, which she wanted. But that's another thing I forgot to mention. I sweetened the deal. So I gave her, I brought her up to 97%. So I'm basically giving her like 112% LTC. I believe, I'm trying to see if that's the exact number we gave her, 85. Yeah. So yeah, I mean, I'm giving her more leverage than what she wanted. I mean, going back to reason why this is for any lender. Like, I like the deal. The first loan was sold off, right? We transferred the risk and sold off. The second loan we're going to keep on our books. There are secondary markets of retail investors. We could sell that, and that's something that I'm exploring. But I'm going to hold on to it right now. It's easy, and we're going to be in and out in less than 6 months. I like, typically with me, like we have another client that we give gap funding for, except we're on like the 4th or 5th year. I forget, I'm losing track. He does about a deal a month or 2 deals a month. And we actually gave him 100%, right, financing. He brings similar deals like this, small little budgets, and we'll give all the money. And like going back with him, the same thing. He's like, Adam, like, I could, I have private lenders that are cheaper. I'm like, great. But it's like, Adam, the only reason why I'm using you because you're reliable. I don't know if they're going to be around. Like, I don't know if I have a deal, I can call up, So he's like, what I do is I systemize it. He's doing deals at Barnegat, Stanhope, we closed one in East Brunswick, and then Brick, right? And he knows the money's more expensive, but he likes the fact that the customer service is very fast. He likes the fact that we're reliable, right? And I'll work with him. Sometimes appraisals, like I remember the first videos we did, the appraisal came in lower, and I end up giving him more money to make up the difference because he had to come out of pocket. But the interesting thing is the property sold for more than what the appraisal said on the onset. They actually sold for more, which goes to show you that appraisals own their opinions of values. But with this client, same thing. He's finding deals that are lipsticks. These are the deals that I like. And lipsticks, same thing, similar resale value in the 400 range. Really depends. We've done gap funding where resale is like 7, but that market, there's very low supply, high demand. So we customize it where we'll roll in all, like we'll give him one loan. He's at 90-100, meaning he puts only 10% down. We're filling in the gap, and then we're rolling in all the costs. So he has no money out of pocket. He's in and out in less than 6 months. A lot of times he's in and out in like a few months. We've done gap funding for another scenario that we'll do is for no interest payments, right? So what we'll do is we'll just prepay the interest payments up front. So we have the first loan and then the second loan, And what we'll do is we'll just prepay the interest payments. We maybe roll in some closing costs and we'll prepay maybe 6 months, no interest payments. And then we'll roll in the interest payments. So there's no interest payments on the B piece or the second loan. Okay. So now they have no interest payments for like 6 months. But the goal is they're going to be in and out in 6 months or less. So to go back, does anybody have questions on how I, my logic of what I'm doing? So that's one way that you could do it with, let's say, for example, if you have your own gap funder, great. You could use them to do the same strategy, cover down payment, prepay your interest payments. So you have no interest payments for 6 months. Let's say another thing that I've done, or you could use another gap funder for, it's like, okay, well, I don't need your money for the down payment. That's fine. I had the 10%. I had the money for closing. But what I need is, I have $100,000 reno. I need 25% of that right now to get the project started. Because I got, fine, we could do that. Let's have that conversation first. Or, and then what we'll do is we'll close, we'll give you that 90%, assuming you're a 9100 client, give you 90%, you put 10% down. We'll send over an extra 25,000, assuming, we agree to $25,000, 25% of your $100,000 budget. That'll get your project started. So that's that's ways that you can get creative. I'm trying to think of some other scenarios that you can use. I mean, you can use it so many different ways. And going back, we have resources where where they'll show you how to get like unsecured lines of credit as well, that you can use that as gap funding. Obviously, like that money could run out, but that's another option. And you can use that for down payment, and then you can use like gap funding for someone else. There's so many different ways to structure it. I'm trying to see if anybody has any questions. Let me see the private chat. Anybody here? Okay. So going back, this is kind of like my logic. Whereas we just closed on this loan yesterday. It very interesting deal. Like I said, client said that they they qualify for the highest leverage. They had over 10 deals. They can only prove they've done let's say 4 deals, and then they have a realtor license. So we're like, okay, you're not 9100. I mean, you're not the highest leverage without perks. We're going to give you 85%. And their logic was, well, we really we have another deal in the works, and we really need extra, we need help scaling, and we want to do 10, 12 deals a year. That little 5% is, we could be using that for another deal. I'm like, okay. So I got it. And the solution was, I was just going to give more money as a second loan. I'm bringing them up to, I believe it was 97%. So I'm giving them like an extra 12%, like 12% loan to cost, meaning I rolled in closing costs and into the loan. And so instead of having to put out like 40 something thousand, they have to put out like half of that. And they're very, very happy, because now they're going to do another deal, and we're probably going to, and I have to look at the deal. I'm not going to commit to anything on a live stream, but as long as it's a similar deal like this, I'll most likely be okay, assuming everything looks good. And then now allows them to keep on scaling and do more and more deals, and eventually that'll be paid back. And then for me, I could just I can keep on rolling that out. So those are different ways. Like, usually come to someone like me, a one-stop shop that does it all. Either could fund it ourselves. We have other investors, or we could, you go get an unsecured line of credit. I mean, I know people that get business credit cards, and they'll go get unsecured lines of credit from a local bank. That's another way to get down payment money, or gap funding. And then other investors. And like, from what I encourage always is like, look, I could either fund the gap funding myself, or I'll bring in another investor, or I could introduce you to them. And so this is something that my model that we're constantly improving. And I hope I was able to give the audience here ideas of how you can use gap funding. For example, typically, fix and flips, you have to, you put down 25 to 30% down if you're a beginner. right? Same thing. You could, if you want to, you know, it's the same thing. You're just filling in the gap. You're just finding an investor. Um, so that, yeah, I mean, it's pretty simple. I believe they call this the Gator method or Gator lending. But gap funding's been around. It's been around for a very long time, and this is how a lot of investors scale, is that they find gap funders or they got to figure out ways to raise money. But one benefit of coming to, forming a relationship with a lender like me is that once you build a relationship, then we could kind of start standardizing things where you kind of know, oh, I kind of know your model, right? And I have that with some clients. One of my good clients, I know their model, and he already know, and basically he knows that, like, I know his deals, and I know exactly his business plan, so I'm comfortable, and I'll standardize it so it's always the same. And it's smooth. And he's like, Adam, like, you're terrific. You make everything smooth. Another feature he likes, not the tout, but he likes that our draws are 24-hour draws, so it speeds up the velocity of money. Yeah, so that's really pretty much on gap funding that I could think of right now. I'm sure there's, if you guys have questions, feel free, write it in the chat. Please like, subscribe, share, and like that in the chat. And let me know if you want me to go further into how this gap funding works. But it's I could definitely show another video and explain it more, but I just want to give you a high-level view of how we just did a recent deal and how you could use it. All right. So everybody, thank you so much for your time. I appreciate everyone on here. And I'll see you next Friday. Take care now.